Everyone, hope everything is going well. All right, so I wanted to touch base on another bank that's closed by the regulators. It's Signature Bank, and it's a publicly traded company from my knowledge. So the thing is, the FDIC will bail this out, and they did bail out the individuals who had insured deposits at the SVB bank. And now there are reports that the Fed is going to come in and going to bail out these depositors, uninsured depositors, because the systemic risk, according to all these elites, is that, hey, look, if businesses don't have confidence in the bank that, they can hold over $250,000 to make payroll, then there's going to be a loss of confidence. So I think that's why they're trying to stop these bank runs before a fire blows out. And the thing with fractional reserve lending is that, okay, say that on paper they have 100 million deposits, but in reality, they may only have maybe close to $5 million. I'm just throwing a number, right? $5 million in deposits, right? So the first 5 million that take the money out, well, they're fine. The rest of the people, well, they don't have the money because it's all lent out to long-term illiquid securities. This is, how the fractional reserve banking system works. You borrow short and lend into long illiquid securities. So let's take a look at this article on Zero Hedge. It says the Fed financing will be made through the creation of a new bank term funding program, offering loans up to 1 year in length to banks, saving associations, credit unions, and other eligible depository institutions pledging U.S. Treasuries, agency debt, and mortgage-backed securities, and other qualifying assets as collateral. These assets will be valued at par. The BTFP will be an additional source of liquidity against high quality securities, eliminating institutions' need to quickly sell those securities in times of stress. So the Fed explained that the Department of Treasury will make up to $25 billion from the Exchange Stabilization Fund as a backstop to the BTFP. All right, and then it goes down. It will pledge collateral at par, not at market value, thus giving banks credit for all those hundreds of billions in unrealized net losses, and allowing banks to unlock liquidity based on losses, which the Fed and TSY now backstop. This is crazy. This was the issue in 2008. 2008, you had the issue of mark to market. And then they changed, okay, we're going to relieve these rules. And once they relieved these rules in March of 2009, the market just went bananas. I was in grad school at that time and we learned about it. I'm like, oh, okay, the market's going to go up. So you're looking at this, and this is something that I expected to happen, is going to happen in our lifetime, where the banking system's fragile, the whole system just too much debt, and eventually you just can't keep interest rates too low for too long, and eventually you're going to have them over leveraging themselves. And this is what happened, right? Now, that being said, I think this is going to be bullish for the markets, at least in the next year. So now, you're going to have volatility, no doubt about that. And, we still don't know what's going to happen with the rate hikes. And also you have corporate tax payments in March, and then there's tax payments in April. So that will, in my opinion, cause some liquidity issue, not liquidity, but it will cause some volatility. But ultimately for the next year, if the Fed's saying, hey, look, we're going to come in and bail these banks out, what are they going to do with the rate hikes? If they're going to raise rates, it's not going to be as aggressive as, they were saying. But, we shall see, right? Anything is on the table. All right. There's a few things, and it says Powell, Yellen, and Grunberg all said that they're taking decisive actions to protect the U.S. economy by strengthening public confidence in our banking system. And let's look at this. Additionally, the trio announced that all depositors at Silicon Valley Bank will be bailed out, as will the depositor of New York Signature Bank, which just failed as well, and whose depositors will be made whole after invoking a systemic risk exception. After receiving a recommendation from the boards of the FDIC and Federal Reserve and consulting with the President, Secretary Yellen approved actions enabling the FDIC to complete resolution Silicon Valley Bank in a manner protecting all depositors. Depositors will have access to all their money starting Monday, March 13th. No losses associated with the resolution of Silicon Valley will be borne to the taxpayer. We also announcing a similar systemic risk exception for Signature Bank, New York, which was closed today by the state chartering authority. All depositors of this institution will be made whole, as with the resolution of Silicon Valley Bank. No losses will be borne by the taxpayer. While depositors are safe, creditors and equity holders are not. Shareholders and unsecured debt holders will not be protected. Senior management has also been removed. Any losses from deposit insurance fund to support uninsured deposits will be recovered by a special assessment on banks as required by law. Now, the thing is, they're making exceptions for this now, but I told you, they can't do this for all the banks in the future, right? Suppose there is a problem down the road, which I believe there will be. I think in the next year, year and a half, you're going to see some crazy things go on, in my opinion, right? Could see the markets hit all-time highs in the next year, but after that, I expect some crazy things to go on. And I think we're going to see bail-ins because they can't bail out. Okay, they could bail out Signature Bank. They could bail out SVB. Okay, they could get away with it. But what happens when you have a widespread panic and people are just like, hey, where should I park my money? Now, that's going to be a huge question, right? And the thing is, this happened in Greece, like I said. I like the description on Google. Okay, a bail-in. Let's look at Greece. Look at that example. Or Cyprus. I think it was Cyprus that I saw the other day that gave a good example. Let's try to look at what is a bail-in. Okay, we could go back to this. A bail-in is a form of financial relief for a financial institution. It provides relief for an institution that is at risk of failure. It does it by making so any debt that is owed to depositors and creditors is canceled. A bail-in is not the same as a bailout. So it's saying that banks have authority to take control of any capital that fits criteria as per the law. This means anyone who has an account that exceeds $250,000 insured limit may be affected. Anything above that amount can be used for bail-in purposes. So this is what happened in Cyprus. This is what happened in Greece, where anything over the insured amount, from my memory, they got taxed. So that's going to be happening. So we shall see how it goes. I'm quite interested in how the government would act. Anyways, guys and gals, let me know what you think. Remember to smash that like button, subscribe if you haven't, comment down below. Thank you. Bye.